So I want to talk about the recession that we're in right now. And to do that, I want to look back and sketch out some of the patterns, how recessions affect different people. And I should say these are my own views, not necessarily those of anyone else at the Fed. So I'm going to characterize what happens in recessions by saying it is whiplash. People who are even going into the recession in more vulnerable situations get hit the worst. So the way I want to do it is, as I said, go back and look how these patterns, and they're not always the same, but they are pretty similar, how recessions play out, what I'm calling recession dynamics. And a really, really important fact to keep in mind is that these recession dynamics take several years to play out. And by several, I mean 2, 3, 4 in a not so difficult recession, but as we'll see for the Great Recession, it took closer to a decade for some of these shocks, some of these patterns to play themselves out. Now, what is the recession we're facing right now? We don't know. At this point, my own view is that it does not look good, that we may indeed be in for something possibly of the same order of magnitude as the Great Recession. So the basic notion of the recession dynamics is we get some shock that hits the economy. This time, obviously, it's the pandemic, the public health emergency. The last time it was more the bursting of the housing bubble and then the tremors that went through the financial system. But the initial impact for the ordinary person, of course, excuse me, is in the labor market. Unemployment spikes, and we definitely saw that. Incomes typically start to decline fairly quickly as people lose jobs, but of course there is unemployment insurance. And this time was different, and I'll show you a little bit how different it was, because we got very, very rapidly a very large fiscal package, the CARES Act, that provided a lot of support for a lot of people. Obviously not everyone, but it really created, almost paradoxically, income is going to be very strong this year overall. It's going to look like we had a massive recession and a huge increase in household income, and that's entirely due to the CARES Act. And then the third stage is financial distress emerges. Now, of course, for some people, that stage can happen fairly quickly if they're not operating with very many financial buffers. But if you think about the bulk of the population, it takes a little while, the job loss, the income decline as some of the safety net support fades, and then we start to see really serious financial distress. So I'm going to look at each of those three dimensions and kind of see what the patterns are. And there's a little bit of evidence on what we're seeing already. And then when David and I talk about this more, I think we'll try to speculate a little bit about what this is going to look like as we go forward. So as you know, we've already experienced that first part of this dynamic process. We had a massive unemployment shock beginning in March. It is, the unemployment rate is coming down, but certainly lots and lots and lots of people still without work. The CARES Act, passed in late March, supported household incomes for many people through July, but that act, many of the provisions expired at the end of July, and there is no replacement in sight. It is remarkable. I'm thinking of my own, some of the speaking I was doing back in that period, July, August, and I think it's true across the board. Economists of all political stripes, all ideological, methodological perspectives, all thought there would be something, that there would be some follow-on fiscal response, maybe not as big as the CARES Act, but something. And the fact that there has been nothing, there has been some administrative action, but that's very small. It is remarkable, and it's, I think, hasn't really filtered through entirely, possibly even to financial markets, how serious that is, the lack of follow-through. If you're listening to Chairman Powell of the Fed, he has repeatedly said, consistently said, monetary policy cannot do all of the work at this point. We need that fiscal support, and it doesn't appear to be happening. So that's a major reason why I'm very, very concerned about the outlook at this point. So the third stage then that I'm highlighting is these large increases in debt delinquency and housing insecurity. My own view is that We're starting to see some signs, but that has been delayed both because of the income support in the fiscal package, of course, the Fed's policies to lower interest rates, being passed through to mortgage rates to some extent, but also moratoriums on foreclosures and evictions. But those are really not permanent solutions at all. It's the income that has to be replaced either through, hopefully through jobs, but if failing that, some fiscal support. So we may only be seeing a delay rather than actually an avoidance or elimination of these serious problems in the financial sphere. And of course, that was just a general picture when you look at the aggregate numbers, but we know that recessions hit vulnerable people the hardest. So all of the things that I just went through apply even more so for vulnerable families and workers. And by vulnerable, I mean non-white, young, less educated workers and families, people with disabilities, women, and of course, there's a lot of attention this time. The COVID recession seems to be hitting women especially hard, just because of the rearrangement of work and life that is taking place. So I will conclude tentatively that this is not looking good, folks. This recession could well be of the same order of magnitude of the Great Recession, in my view. So I want to go through those stages, and I'll use history to kind of illustrate the point. These slides will be available. I'm sure Gina, Alyssa, and Tanika will make them available. So it's not important that you look at each individual picture and remember specific numbers, but just the patterns are what I'm trying to show you. So first, unemployment. What happens across different racial groups when a recession hits? And so this also is not looking at the different levels of unemployment across long periods of time. This is looking specifically at the changes that occur in those levels when a recession hits. So in each of these pictures that I show you, I've arranged the data so that year 0 is the year in which the economy peaks before it goes into a recession. So for example, here in 1973 was year 0. And so reading to the right, year 1 was 1974, 75, etc. So this is now, I'm going to first look at so-called prime age workers, 25 to 54. Then I'll also look at older and younger workers. So prime age white unemployment rose 3 percentage points from 1973 to 1975. You can see that the black prime age unemployment rate rose by closer to 5 percentage points. So the rule of thumb that you often hear, and these pictures will bear this out, that the black unemployment rate typically is over time roughly twice the white rate. But what I'm highlighting here is that the increase in a recession and the period following that also is close to twice as high. So the unemployment level is higher and the displacement, the shock, is bigger experienced by Black workers. Here's the 1979 experience, that's year 0. Here, of course, we had almost back-to-back recessions. So there was a sharp recession that hit, really felt it in 1980, 1979 was the peak. And then if you count forward, 1981 and 1982 were another recession, in fact, deeper even than the 1980 recession. So the cumulative effect you can see is much higher unemployment. And also notice how long these unemployment shocks last, well out into the 5, 6, 7 year range in this episode. Then in 1990, this is an exception, one of the rare exceptions where it would be very difficult to make the argument that the cyclical dynamics of unemployment were noticeably different between white and Black prime age workers. I will show you that for young workers, for example, the more general pattern did hold, but this was an example of a little bit unusual pattern. Then in 2000, we start to get data for other groups, for Hispanics and for Asians. And again, these are all prime age workers. 2000 is the peak here, and see that the increases range from 1.5 up to 3 percentage points, with many years for this shock to play through. But this is a little bit unusual because if you look at the data, especially after the data have been revised, there's almost no recession there. Real GDP didn't decline in any year. And so the fact that even it was really more of a pause, as I'm indicating, than a classic business cycle recession, it still had these very profound effects, raising unemployment and the differential effects across different groups. Then we moved to the Great Recession, 2007 being the peak. And this was, of course, a historically bad episode, both that it was a very, very deep shock. It was across the economy, transmitted through the financial system. And as you can see, it took many, many years to get back to the levels of unemployment that prevailed in 2007. And again, you see these patterns, the Hispanic and Black unemployment rates rising much more than the white. You can also see here the Asian unemployment rate was much more similar to white. Then, if we look at young workers, people 16 to 24. So these are, of course, people who are in school are not considered in the labor market, so they're not counted either way, employed or unemployed. But these are people who are looking for work and are become unemployed. So the change for Black young workers, you can see peaks at about a 9 percentage point increase in that 1973 episode versus closer to 5. And the recovery is slower for young Black workers in terms of unemployment rate. Here's the 1979. Remember, there was a follow-on recession, 81, 82. Black young person unemployment rose 10 percentage points, and it lasted several years. Here's 1990, closer to that historical pattern where the Black unemployment rate gets hit much harder than the white. Here's 2000, which, as I said, was more of a pause than a recession, and yet Black young unemployment went up well over 5%, double that of the white rate. And then in the Great Recession, in this case, I would characterize this as really young workers of all races and ethnicities got hit very hard. Still, you see the differentially higher effects for Black and Hispanics, but also white and Asian unemployment for young workers went up 7 to 8 percentage points. And again, it took close to a decade to get back to that pre-recession level. And then briefly, just for comparison, older workers, those age 55 and above, and again, people who are retired are not considered out of work, they have chosen not to seek work. So these are only people 55 and over who would like to be working. The unemployment rates certainly showed the effects of the recession, but much less than for prime age and especially young workers. So what do we know so far about the 2020 recession? And so in this picture, 0 is again 2019. The years to the left are counting backwards in time. And then I've switched to the months. We have data through August, and you can see that after March, really starting in April, unemployment rates spiked. These are again prime age workers. And Hispanic workers show the biggest increase in April, but all non-white groups, even by May, by June, July, you can see again that classic pattern of the prime age white workers. Unemployment is not as high, nor does it rise as high or stay as high as long as for non-white workers. Here are the older workers, similar qualitatively. The white rate goes up about 10 percentage points, which is remarkable for older workers, because this is a group also that typically, if people lose jobs, they're, of course, in this age group, much more likely to drop out of the labor force, to take, to retire maybe a little earlier than they expected. And then finally, for this comparison, during the Great Recession, so far in 2020, young workers have been very much affected. I mean, look at for example, in this case, Asian workers, 16 to 24, the unemployment rate went up 26 percentage points between the beginning of the year and May. So this has been truly an unbelievable shock. Now, the rates are coming down faster than you would have expected, maybe given previous shocks. There is some evidence that the improvement in the labor market is stalling out right now, largely, I think, because of the expiration of the CARES Act and the failure for any follow-on support. So that was unemployment. Another way to think about it is look at the incomes, and these are for the households now, so it could be multiple workers, also multiple sources of income, labor income, transfer payments, interest, and dividends. So everything all combined, proprietor's income also. So this from the 1973 recession, The 0 year, 1973, these are rebased to be 100. So think of it as 100% of the income, whatever that was for each group in that year. And as you would expect, after the recession, incomes go down. These are adjusted for inflation, and these take the median, the family exactly in the middle for each of these groups. The point that I stressed before is of course true here again too. This is a multi-year process. The recession has a very long shadow in terms of pushing down incomes across these groups, and it's only 5 years out when the median has recovered to the level of the 1973 incomes. Then at the 1979, more longer, protracted, and deeper declines in income. And here the pattern is more clear that Black and Hispanic incomes were hit harder, dropped further than white inflation-adjusted incomes. Here for 1990, all groups saw big declines, especially in this case for Hispanic and Asian workers, or families rather, as you look at even 5 years, not seeing much recovery. In the 2000 pause cycle, white median family income declined only slightly, kind of a sluggish recovery, much more pronounced for non-white families. We saw bigger, more typical of some of those earlier recessions. And then here's the Great Recession. All groups saw big declines in income. And you can see that those income drops didn't bottom out until 4 or 5, or in case of Hispanic, even 6 years after the 2007 peak. So these are very slow-moving recession dynamics that work their way through these, from employment to income, and then we're going to move to the financial indicators. But the last point to make, so the latest information we have through the second quarter here, what I'm illustrating here was how large and how timely the CARES Act was. So the two series here in orange, this is adjusted for inflation, adjusted for population growth. This is the change year over year in disposable personal income, what you have after taxes to buy goods and services. The orange line excludes government transfer payments, things like unemployment insurance and the extra CARES Act payments. Those blue, and then the blue line includes the government transfer payments. So as you look over the previous decades, they don't differ a lot. If you look at, for example, in recession periods around 2000, the blue line is higher than the orange. In the Great Recession, the blue line is higher. That's because transfer payments, unemployment insurance did kick in and they supported incomes. But now we move to the present. That's the second quarter. And you can see that the orange line dropped hugely, 6% down from a year ago. So this is a very big shock to people's incomes before considering transfer payments. But then once you take into account unemployment insurance and the one-time payments, the blue line indicates this has actually been an enormous increase in income in the household sector, at least through the second quarter. So this is, I think this is part of the reason that a lot of people are very confused. And I would put the financial markets. I think the stock market, a lot of investors are very confused about what the state of the economy is. Because, for example, you see strength in housing, you see strength in income, and that is entirely due to the fiscal policy response. And it doesn't appear to be, it's not going to be continued. So what about homeownership rates? So this is kind of an indicator moving toward this financial distress notion. We don't have as much data broken down by race and ethnicity here, but this is, again, change in the homeownership rate around the business cycle peak, which was around 2000 in that case. This is a little misleading. I even hesitated whether even to show you this, because you would expect homeownership to go down after a recession. In fact, it went up after this period. I think the main reasons are two reasons. One, this was a very mild business cycle, so it didn't have those effects possibly. Secondly, this was really the beginning period of the housing bubble, which really I would say dated from the late 1990s. So we had a huge surge, people focusing on the housing market, lots of credit flowing into the housing mortgage markets. And so you I think, see the housing bubble really inflating in this period. What is much more what you would expect in a recession is the Great Recession. This was, if anything, exaggerated by the bursting of the housing bubble. But it also points to this idea that the homeownership rate declines after the recession. And here you can see the peak took 8, 9, 10 years to be reached for different groups. And then it's only after that that you started to see some recovery in the homeownership rate. And by groups, this pattern is familiar. The white, non-Hispanic white homeownership rate did not decline as much, quite as much as it did for other groups. And for African Americans, even 12 years out, the homeownership rate is still 5 percentage points below what it was in 2007. And then if you look at the other end of the chart, actually the Black homeownership rate peaked before that in about 2003 or 2004. So it's down from that peak even more. So here's a picture of mortgage distress. This is not to say that we will see those levels again that we saw in the Great Recession. This is for the US, the blue line, and then for Illinois and Missouri, you know, there's quite a bit of range across different parts of the country. But at the peak in 2009, 10% of US mortgages and more like 11% of mortgages in Illinois were what I'm calling seriously distressed. That's at least 90 days delinquent on payments, but not yet in foreclosure or in the foreclosure process. And that very, very high level of distress persisted for a couple of years. It was only in the late 2000s that we got back down to levels prior to the Great Recession. And then the latest figures here are for the second quarter of this year. So through June 30th, we've seen a very large, very sharp increase in this serious delinquency rate. These numbers are going to be confusing for some time because of the moratoria, the forbearance that's going on. But I think there's reason to be quite concerned that these delinquency rates are going to go up. Here's from the Household Pulse survey, the share of owners not current on their mortgage by race and ethnicity. Again, whites have the lowest level of current distress reported in this survey, and this was taken in August. And then for renters, about twice as high. Patterns are similar. Non-white renters across all racial and ethnic groups, quite a bit higher level of reported distress. So summing up, I think the employment shock in this recession was more regressive than usual. I started with the premise that more vulnerable people always get hit harder by recessions, but I think this one is even worse because of the way it hit the service sector and the way our economy is organized with so many lower wage jobs in the service sector. So I think we're going to see, we already have seen, we'll continue to see lower income people are going to be disproportionately affected. Unless a replacement for the CARES Act is created, and I see no prospect for that anytime soon, household incomes are likely to decline for several years, showing that pattern that we saw before. Greater debt delinquency and housing insecurity, then I'm fearing will be a matter of when, not if. And put it all together, the economic and financial damage suffered by millions, tens of millions of vulnerable people and families could surpass that of the Great Recession. Now, do we have time to act? Absolutely. There's a lot that could be done. It is really, in my own view, tragic that we're not seeing more broad efforts to make a difference early in this crisis. So I'll leave it at that.
Okay, Bill, thank you very much for that. Gina and Lissa, do we have 5 minutes here? I know we're over time. We have a couple questions here. You know, really the through line between both presentations is what we can learn from history, and I think that this is a really nice transition. So the first question from Margaret Shradden says, we see these patterns in unemployment, income, home ownership repeating, hurting households of color much more. The stimulus addressed the problem for a short time, but in the big picture, what policies could change these underlying patterns? And of course, we have a mostly social work audience, so if you could tailor comments to that.
Well, I think, hello, Margaret. I think, you know, the point, the premise of the conference is exactly the answer here. That I maybe didn't emphasize it, but the idea that how do we define vulnerability? It's, and I really have more of a focus on the financial vulnerability. So increasing people's financial capabilities, their ability to not just create mobility, longer term goals for themselves and their families, but also to be able to withstand shocks, is one, I think, of the underappreciated reasons why we need to be concerned about helping not just the wealthy, but everybody be more aware, more capable of managing their financial lives, so that these shocks that are inevitable, I mean, this is, we really drew the short straw this time, but you have to expect that there will be these shocks that come along. And so building financial capability, financial resilience, I think has to be, really that's the only feasible way to think that we're going to improve people's experiences.
Yep, and there's another question here, and it's kind of longer. I'm just going to try and get to the point. Social workers are deeply concerned about asset accessibility for vulnerable populations. What are your thoughts to the Fed being identified as playing some role in runaway inflation?
You broke up there. Runaway what? Asset
price inflation.
Right. That, speaking for myself, that is a concern. I guess this is, you'll think this is an evasive answer, but I really don't think it is. I think what we've seen coming out of the last recession and this one, at a minimum, possibly you could think about it even, well, I would go back even further. We as a society, we as policymakers have relied too much on the Fed to lower interest rates to try to buffer the economy overall. And that has had the effect of elevating asset prices. I mean, that's an elemental, fundamental financial concept. Lower interest rates, all else equal, will push up asset prices. And you've heard it so many times, and it's still true. We need other tools. We can't rely on the Fed to do everything. And I think, in fact, my own view is we've pushed the Fed so far that it truly has distorted asset markets. I think it's distorted, it's encouraged probably too much debt accumulation. And the obvious thing in a crisis like this, of course, is fiscal policy. And we saw what fiscal policy can do in the spring and summer. And of course, we're seeing now the absence of fiscal policy, how damaging that is. So, I agree with the premise of the comment or question that the Fed is in some way involved in asset price increases. And I guess I think I would say this was Ben Bernanke's view back in the financial crisis. If you don't get the follow through, the coordination from other policy tools, the Fed felt they had to do what they could. And that will be controversial, I think, as we look back in history, whether the Fed of its own volition or by default did go too far in trying to use financial tools. Kind of echoing the earlier question in the earlier session about the financialization of the economy. This is the financialization of macroeconomic policy, thinking that the Fed can do everything by cutting interest rates. And I think it has some really pernicious effects.
Okay, I'm getting indications that we need to wrap up. I want to thank Dr. Bill Emmons for your talk and setting us up to discuss many of these important issues around, really the role that fiscal policy can play coming in out of the COVID recession. So thanks, Bill.
Thank you very much, David.